Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Reema Tendulkar and Hormis Fatakia. Hey guys, good morning. Finally Friday. That's the most important cue for today. Apart from the fact that after touching those record high levels yesterday, we came off sharply. Today, there is an attempt for recovery, but we've again, after recovering from the lows of the day, the low today was 26,172. We are, of course, 82 points off the lows of the day. But again, there is some attempt of a sell-off from the highs of the day. So we've come off around 30 points from there. The mid-caps, they are underperforming yet again. So there is, it is in the red. It's been quite volatile since the start of the trading day. The advance decline ratio, though, in favor of advances right now, but we'll keep tracking the market bread because that is an important cue to track for the broader markets. Look at those lines. It's been a zigzag through the course of the trading day today. Autos doing well, metals again, batting it for the bulls. But we have some losses coming in from realty, small caps, and the CPSE index. Hey, Reema.
Hi, autos is going to be important because over the weekend we'll get the auto sales numbers for the month of November, and after the festive season boost that we got in the prior month, everyone's going to watch whether that demand sustains and will continue. So autos in focus, and particularly M&M continues to gain ground. Remember yesterday Sudarshan was talking about their new launch. Feature loaded is what he said, at an aggressive price, I think close to about 20 lakh. And the launcher, the official sales will begin only in January, but the street quite likes what they've seen, and that stock continues to gain ground. And the other one is Reliance Industries. This week, we've seen the second bullish note on Reliance Industries. On Tuesday, it was JP Morgan, and today it is Jefferies with a target price of 1785 on Reliance, and that's helping the bulls today. But, Hormis, what else?
You know, there are broader markets they have remained choppy all through the week, to be very honest. But then there have been stock-specific actions on both sides of the spectrum. Let's start with all cargo logistics today. The stock has snapped a 5-day losing streak, the biggest single-day gain that the stock has seen since November of 2021 in today's session. And it has reversed that entire 21% decline that it saw in the last 5 trading sessions. The stock today has seen close to 45 lakh shares that have been traded, 20-day average of just around 20 lakh shares, and it's trading above its key moving averages somewhere between the 12 rupees to the 13 rupees mark. Now, Reflex Industries is an order win reaction, the 12% higher on the stock, the biggest single day gain in 3 months. Volumes are the highest in nearly 4 months. Over 1 crore shares have been traded already on Reflex Industries. The 20-day average is only 1 lakh, and the stock has moved above its 50-day moving average of 356. It was below all of its key moving averages before this. The stock is down around 25% this year, but had more than quadrupled in 2024. And lastly, GAIL, of course, a news flow driven reaction in today's session, has declined in 5 out of the last 6 sessions already. The volumes are already the highest in 5 months. We've had close to 3 crore shares on GAIL that have been traded in the first couple of hours of today's trade. The 20-day average is only 18 lakh shares, and the stock has slipped below its key moving averages, and so far down around 10% year to date, and set to be the first negative year since 2019.
Okay, all right. So that is about GAIL, and let's continue that story and talk about GAIL in greater detail. Of course, this is the big story that we are tracking for the day. The news is that there is an announcement on tariffs for GAIL's transmission pipeline. It has come in lower than what the street was anticipating. So the new tariff has come in at 65.69 rupees per MMBTU, which is a 12% increase from the current levels. However, it is lower. The ask from GAIL was a 33% hike to 78 rupees, and the analyst community believe that maybe not around 33% hike, but there could be at least a 20% hike which will be on the cards, and that is what everyone baked in their estimates as well. So 12% is much lower than both these parameters which was expected by the street. However, this is just an interim relief, as the order says, and as GAIL and PNGRB also told us. Regulator has not considered adjustments for future and actual operating expenditure and capital expenditure in this particular calculation that came by. They only made these calculation basis 2 things: the capacity and also the deallocation of APM gas that took place. Such adjustments, all of the other factors, will be taken up in 2028. That is when the next leg of revision for tariffs will come by for GAIL, and the estimate is by PNGRB as well that is when they will get full benefit of a tariff hike. PNGRB also indicated they wanted to make this process very smooth and now not go at one go for tariff hike because that will impact customers as well. What are brokerages making of this? UBS has a buy with a target price of 215 rupees a share. They say that tariff hike disappointed and increase in realized tariffs could even be lower. 12% does not increase announced tariffs does not mean the realized tariffs will be equivalent because other costs will be taken into consideration as well. However, regulator has deferred review of other parameters from FY28, and this is something that would lead to material increase in tariff and can place unexpected financial pressure on customers. So this is something that we'll be tracking very closely. Citi has a buy. They also have a similar target price. They say this is below 15% that had built into forecast and well below 33% hike that GAIL was seeking. This should now set in motion implementation of new unified tariff regime, which is material positive for IGL. Jeffrey says because of this tariff hike, they say it is largely in line. They had expected around 15%. They say they build a new tariff and raise both FY27 and FY28 estimates by 7% each. Tariff hike is in line with expectation. They have a buy rating with a target price of 230 rupees a share. So this is what the brokerage view is in terms of GAIL. In fact, we spoke to PNGRB earlier today. They told us that this is just an interim relief and that tariffs will be revised in 2028 again. Listen into what they had to say and their reasoning as well on this number.
We have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll true up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all true up all the factors, capex, opex, relief, everything we will give. Two reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas. Of APM gas by the ministry. So these are the two basic reasons, and wherein we have determined the tariff of 65.69, considering all the three factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL.
To understand the impact further, we also spoke to Rakesh Kumar Jain, the Director of Finance at GAIL, and the company, and we asked him that this has been lower than what the company was seeking. So how do they feel about it? What will be the impact? Listen to what they had to say.
We submitted our tariff of 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles of parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So in this case, PNGRB asked us to file the midterm review, and we filed it. It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees per annum. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70, 72 rupees, but it has come down to 65 rupees, 69. But there is a gap from our expectations of around 5, 6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Take a short break, but just as we do that, here's a quick programming note. If you're looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Somaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. You can ask your questions live today at 1:30 p.m. by becoming a member on the CNBC-TV18 app or logging on to cnbctv18.com/access/plans. Welcome back. Shifting focus to the crypto markets now. Manisha is here with all the updates. Manisha.
Well, thank you for that. Today, I'm taking you with the journey and sense of Bitcoin. Remember, it was launched way back in 2009, and that is what we had started talking about it as well. The Genesis block was actually mined on 3rd of January 2009, and that is what marked the birth of the world's first cryptocurrency therein. Well, it was not established yet then, and the prices started being marked only in 2010. But initially, when the cryptocurrency came along, it was informally traded between early adopters there. There was no established market prices, and there was no established market platform to begin with as well. Well, you also know that the protocol limits the supply of Bitcoin to just about 21 million coins, and is the reason that there is support that continues into that space as well. When you look at Bitcoin, really, we've seen a low of 83,000. From there, we've seen a rebound up to 91,000 as well within that last 1 week. So strong gains coming back into that cryptocurrency there. There have been major reasons for the movement that we've seen in Bitcoin in many last years. First of all is the investor interest, the adoptional interest. We also have seen retail institutions, banks, corporates, even governments start to adopt it, and that is where the support comes in from. The cryptocurrencies also have macroeconomic conditions that they have started to react to, whether it is about the dollar, the US Fed interest rates, the equity markets, etc. All of that impact the Bitcoin. The mining difficulty adjustments that we have seen continue to grow in last many years have been yet another reason that you are looking at support come in for Bitcoin there. And then it also has been about competition from other altcoins. Bitcoin halving events also have led to a lot of gains there. And the friendly regulations within the US markets that we saw in this year clearly have led to Bitcoin hitting yet another all-time highs there. I want to take you through prices on how the journey really began. So that was 2009 when the Bitcoin was at 0.004. And as I said, in 2009, nobody was trading cryptos except only the enthusiasts. And it was informal trading within the system itself. 2010 is when the first Bitcoin was traded, and this also is the year that you saw those 2 pizzas being bought by 10,000 Bitcoins. At that point in time in 2010, the low was 0.004 and at 0.5. So it didn't cross $0.50 in that year. And very interestingly, when you look at 2010 to 2013, so if you count 2010 as the year one, so 1, 2, 3, and the 4th year is when you have seen the Bitcoin hit an all-time highs. And as you can see, the 4-year range has been very, very big. But this is something that Bitcoin clearly has been replicating every 4 years is when you see very strong gains come in for Bitcoin. And as you will see in this year as well, this is 2014, 15, 16, and then 17. Look at that. So every 4 years, the 4th year is the year that Bitcoin gives you very, very strong returns there. But take a look at the kind of volatility that we have been looking at in all of those markets there. Yet again, that 4-year thing is replicating here. So 1, 2, 3, and then 4th. So Bitcoin has traded anywhere between 13,000 to 28,000 in the last 4 years. But by the time it was 2021, we saw 68,000 therein. And this is yet again replicating. So 1, 2, 3, and 4. And you have 1,26,000 there. So when you look at the last 4 years, it basically traded anywhere between $40,000 to $50,000 therein. But 126,000 is what we've seen. 106,000 also Bitcoin hit in December 2024. That is when we almost absolutely knew that the US President Trump was coming in. And that is where the euphoria came in from.
It follows its own leap year, right? By the way, Manisha, what were you doing in 2009? That seems like long ago. What was everyone doing here back in 2009?
I was in school.
Oh, okay, we shall then not continue this conversation from here. But thank you, Manisha, for taking us through that Bitcoin journey. It's very interesting to know what levels it used to trade at and where it is right now. So that's the Crypto Corner update. With that, we'll slip into a short break. When we return, we'll discuss market technicals with Mehul Kothari from Anand Rathi Shares.
Welcome back. Sudeep, Pharma has had quite the stellar debut on day one. The stock is up 32%, 787. Very strong up move. This is a pharma company which basically manufactures specialty ingredients which go into pharmaceuticals, nutraceuticals, and personal cares. So their core business revolves around high purity minerals and excipients, that's the word they've used, that go into tablets, syrups, supplements, and fortified foods. So that's pretty strong. We'll try and get you more on that. For now, let's talk about market technicals. Mehul Kothari from Anand Rathi Share and Stockbrokers is now joining in. Mehul, 26,250 after yesterday's high. Markets are just consolidating. What's the near term looking like, the trade that you would take, and then tell us your stock calls.
First of all, thanks, Rima, for having me on the show. And if we talk about Nifty, we have a short-term as well as medium-term view. So for short-term, our view remains positive. As long as Nifty hold on to 25,800, which is the recent swing low, right? The market continues to stay in buy on dips environment. On the upside, we anticipate a move towards 26,500 once we are about 26,300 on spot or a bit slightly higher. However, once this zone is reached, we feel that a decent corrective phase or a healthy pullback is likely in the markets. But most heavyweights, if we talk about, appear to be in the final leg of their up move. But despite that, we remain strongly bullish on the broader markets as of now. It's time for mid caps and small caps, Rima, to begin showing noticeable outperformance, and one should position accordingly from here on. Now, with regards to Bank Nifty, also 60,000 to 61,000 zone may prove very challenging for the bulls due to a major trend and resistance placed there. So, along with Nifty, even Bank Nifty hints for a final leg of upside in the short term.
What about specific stocks, Mehul?
A couple of stocks which we are liking from the heavyweights, we are liking M&M. It is on the verge of breakout and can be considered at current levels of around 37.50 with a stop loss of 3650. The upside potential is towards 3900 to 3950. From the mid-cap space, we are liking data patterns. The stock recently witnessed a strong breakout rally followed by a healthy pullback, so which presents a fresh buying opportunity in the stock. It can be bought somewhere around 3010 to 3020 with a stop loss of 2920 and upside target of 3150 followed by 3200.
Okay, all right. Thank you, Mehul, for joining in today. So those are some technical bets and important levels to watch out for on the Nifty as well. Paytm, that is one stock on our radar amongst one of the top F&O gainers. Nimesh is here with his standout brokerage report of the day. Nimesh, what does the note say?
Hi, Sonal. So the stock is reacting to the big upgrade coming in from Goldman Sachs. So they've upgraded the stock to a buy, and they've sharply raised the target price on Paytm to 1570 versus the earlier target price of 705. So big price upgrade there. Now they believe that the regulatory environment, which was a big drag for the stock in the recent past, that is incrementally getting better, and hence that is going to translate into an early signs of recovery in the Paytm's payments business market share as well as the earnings stability as well. So they are expecting that the company to sustain 20% plus revenue growth in the very near foreseeable future. Additionally, they expect further incremental positives for Paytm if there are any further regulatory changes with regards to the MDR or for that matter further market share gain. So that is why Goldman Sachs expects that the company's EBITDA margin is likely to double over the next 2 to 3 years, and hence the risk reward is favorable. So that's the reason why a big upgrade to a buy, and Goldman Sachs has now raised the target price to 1570.
Okay, take that point, Nimesh. Thank you so much for joining in. So Paytm is on our radar. We'll keep tracking that stock for you. Reliance Industries is the other one. That stock is higher in trade today, contributing to some of the gains that we're seeing on the Nifty, though it has come off from the highs of the day. There is another bullish note on Reliance. This time is coming in from Jefferies. They have a buy call with a target price of 1785 rupees a share. They say all three businesses, the auto chemicals business, retail and Jio, are delivering double-digit growth in FY26 so far. Jio's impending IPO could lead to tariff intervention in the near term, so that will be a key trigger for the company. FMCG is ripe for value discovery in calendar year 2026 itself, and New Energy and data center partnership with Google are the other optionalities. And New Energy is a business on which a lot of analysts are quite bullish once it starts contributing to the P&L as well. But stock is still trading below its mean long-term EV to EBITDA, and that is the reason they are bullish, because of valuation optimism and risk risk reward is favorable at current levels. So Jefferies reiterates it by on the stock with an indication that all three businesses will do well going forward.
Second bullish note this week for Reliance Industries, and the street continues to bet on the stock as it moves closer towards its previous record high levels, somewhere close to 1605 or 1610. So 1572 currently on Reliance Industries. By the way, just before we take that break, pull up Lenskart as well. Now that's at the highest point of the day, and Jefferies initiated coverage on the stock earlier today, a price target of 500 rupees, and that initiation comes just a day before it declares its quarterly results, which is tomorrow. It's first after its listing. Take a short break. We talk more on the markets with George Thomas on the other side from Quantum AMC. Stay tuned. We'll be right back. Welcome back. Still 26,250 being a bit of a hurdle for the index, and Sudeep Pharma now is still up 32%, but shares worth almost 2,000 crores have already been traded on the stock on its listing day. Continuing our conversation on the markets, George Thomas from Quantum AMC is now joining in. George, good morning. Thank you for joining in. The markets may have hit record high levels yesterday, the benchmark indices at least, but the broader markets is where the actual pain lies, right? You see the mid caps, the small caps, the micro caps, at least 2/3 of the stocks have given negative returns this year. Do you believe that the excesses in the broader markets have now been wiped out and now it's the time for the broader markets to outperform, or do you still see some more pain for the next couple of quarters?
Thanks for having me on the show. So we are slightly longer term investors, and generally we base our calls based on what could pan out in the next 2 years. But having said that, so what has happened in the markets in the last 3-4 years was certain pockets, especially in some of the small, mid cap and micro cap names, had rallied to an excessive level, and some of those excesses have corrected in the last few quarters. But our sense is, given the point where we are currently, the earnings growth has not been great for the last many quarters. And there has been a series of actions from the policymakers to boost consumption, and some of it is starting to play out on the ground. So if you look at this year, there has been direct tax cut, indirect tax cuts, and even interest rate cuts, which has happened simultaneously. And along with that, you are sitting at an earnings base, which is not at all ask. So our sense is from here on, the earnings growth should turn for the better. And from a 2-year perspective, we are seeing a fairly good upside for a long-term investor. So we are quite positive on the markets. Our sense is on the large cap space, there are pockets where there is a chance for good upside. But as you come down the market cap in the small cap segment, investors has to be a little more selective, and funds which are cognizant of valuations are likely to outperform over the next couple of years.
In that case, since you're positive on the markets from a 2-year perspective, which are some of the sectors which could contribute to those growths, or you think it has to be very, very stock specific for any fund manager to choose?
See, last couple of years, if you see some of the sectors which has given muted returns are the major pockets of financials, IT, and some of the sectors like consumer staples. But from our portfolio perspective, consumer staples, we are not still reached a level where investors can expect decent returns if you marry valuations versus the earnings growth potential. But our sense is some of the segments like financials and IT should turn around from here on. Financials is a mix of banks and some of the savings related themes like insurance. Banks are seeing some signs of credit growth to kind of moderately picking up from the levels where they are. And as the economy picks up, it should become better from here on. Insurance companies have seen certain transient issues, and in the very recent past, markets were worried about the tax tweaks which happened there. But when we speak to companies, we are seeing most of it has been kind of passed on to the value chain in terms of distributors and stuff. And our sense is from here on, given the attractive pricing because of the tax changes, most likely the ticket sizes can improve and investors should see better growth from here on. The other big pocket where we have a reasonably good upside is IT, where things have been muted for quite a long time. And our sense is from an impact perspective, it is more macro than AI. And as and when the global things settle down, enterprises should start spending and some of these companies should clock decent revenue growth.
But George, there has been a lot of uncertainty with regards to the IT space. I was just reading your note that you have shared. The IT services players reducing their dependence on the H-1B. There have been comments from the US president as early as today with regards to immigration. But the commentary from a lot of the players on ground still suggests that nothing much has fundamentally shifted. There has been this talk over India being an anti-AI play and so on and so forth. But will only a valuation correction be enough for an investor to bet on IT, or the cons far outweigh the pros right now?
See, when you evaluate the IT service spends, how it typically happens is there is a permanent spend which is required for maintenance and which is minimum in nature. And then there are certain good to have projects which is typically called as discretionary projects. So in a bad macro environment, when enterprises are not sure about what could pan out in the next few months, they would keep these discretionary projects on a back burner. But what we have seen in the past many cycles is as and when, and there would be a point where even delaying those discretionary spends would have an impact on the enterprise. So they cannot be deferred forever. That is one angle. The second dimension is whenever there is a tech transition. For instance, there are a lot of use cases or POCs, proof of concepts, which are evolving for these new Gen AI related things. And IT service companies, by nature, they participate at a later stage. They are involved in terms of, so even if there would be a good amount of companies who have created good use cases for generative AI. But from an enterprise perspective, you cannot plug those Gen AI add-ons as is to their existing architecture. So there is substantial amount of work which is required in terms of modifying their existing software architectures, where IT service players come to help. And along with that, there would be a humongous amount of data preparation work. Your existing data could be existing in silos, your applications would be in silos. So this system integration and integrating with new technologies, that is an essential spend. And if you look at the global landscape where the labor force is distributed, India continues to have an edge. And the cost arbitrage between an engineer at the developed country and in India, that continues to be quite favorable. So we don't see any fundamental reason why tech spends on the Indian IT players should underperform in terms of revenue growth for a prolonged period of time.
Okay, all right, Josh, thank you so much for joining us with your market insights and sectoral outlook going forward. With that, let's move on. In an exclusive chat with us, Jonathan Garner of Morgan Stanley said that he remains overweight on India and does not believe that foreign investors are leaving the Indian market yet. Let's listen in as we slip into this very short break.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market. And it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example. To be precise, we are 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000, but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1,400 target.
And what's the bull bear on the Sensex?
76,000 up to 107,000. So quite a wide range.
Welcome back. You're still tuned in to Trading Hour on CNBC-TV18, 26,250 on the Nifty, an important level to watch out for. But a lot of individual stocks on our radar. Lenskart is one of those stocks. Jefferies has initiated a coverage on the stock with a buy rating. There's a target price of 500 as well. Mangalam is joining us with all the details of this note. Mangalam?
Interesting one because, Lenskart reports its numbers this weekend itself. So one weekend before its numbers, there has been an initiating coverage that comes by with a positive, stance here as well. Jefferies has initiated coverage. Their target price is 500 rupees. For perspective, the issue price was that Jefferies was just around that 412 rupees mark itself. They have a couple of drivers for them. They're saying that it's the largest tech-driven eyewear retailer, which holds about 5% market share in the company in the country, and this offers a strong growth potential. It's vertically integrated. The omni-channel model also ensures that there is operational improvement coming in, even as the customer experience improves from here. And India accounts for nearly 85% of their EBITDA, while the international segment is something that gives optionality. So attractive unit economics and fast paybacks, they believe, could actually take EBITDA higher by 50% over the next 3 years on a CAGR basis. Just one word on their valuations though. Jefferies ascribed a valuations of 50 times FY28 EV to EBITDA to Lenskart, assuming that the EBITDA in FY28 would be closer to 1600 crores, which is roughly 3.5 times of what it was in FY25. So it's their projections and the multiple on those projections. So we'll monitor how these actually come about as compared to the actuals for the company going forward.
Thank you very much for that. But the stock has held up well, right? Around the time of the IPO, everyone was so worried about the valuations, very expensive. It did drop to 350. That was the low, I think, in the month of November. But it's climbed back up to 425. So vis-a-vis issue price, I'm saying it's held up pretty okay. If you compare it to, say, an urban company, which, compared to the highs of 200, has seen quite a fall. Mangla?
No, the other thing that we need to monitor is that the first block of anchor investors opens sometime in the early part of next month itself. So until that happens, limited float which is available in the market for the stock to be traded. So unless and until there is more supply that comes in or more stock opens up for trade, we'll find an equilibrium there. And maybe the street's holding on right now, also waiting for their results to come by. Who's to know that, the first couple of quarters after the company lists, usually the results are fairly strong. So maybe the street is playing for that as well.
8th of December is that day. when the lock-in opens for almost 4.1 crore shares. 2% of outstanding will become eligible to be traded that day. Mangalam, thank you for that update there on Lenskart, holding above its IPO price. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. One important macro indicator that the street will be tracking will be the second quarter GDP numbers. And the good news is that that number could be as eye-popping as the Q1 number. So the CNBC-TV18 poll sees the Q2 GDP growth at 7.4%. This compares, remember, with 7.8% in Q1. Lata joins in with more on this. Lata, looks like it's going to be a good show today.
One reason why it's good is look at the year ago number, 5.6%. That was a terrible second quarter we had. So it's perhaps easy to look good because of that. And it's a tad lower than the 7.8%, which was a genuinely eye-popping number which we got for Q1. However, this is real GDP is what we are talking about. That is, we are taking away the price effect. We're only looking at the rise in goods and services. If you add the price effect, what you call nominal GDP, that's growing at only 8% versus 8.3 year ago and versus 8.8 in Q1 and versus a union budget assumption of 10.8%. So clearly there are going to be problems because of that. The growth at the moment, let us look at the good news. The real GDP growing by 7.4 is going to be helped by all sectors. That is agri, manufacturing and services. Agriculture is seen growing at 3.5, which is very good for agriculture. You know, there are limits. You can't expect it to grow at 8%. Manufacturing, very good, expected to grow at 8.9%, partly because of the front loading of exports and a very good capex spend by the government. Both those helped manufacturing, and services also doing very well at 8.1. Largely finance, real estate, trade, all of them did well. The poll for Q3 and Q4 are also in, but they're preliminary numbers. Q3 is expected to grow, that is the current quarter, at 6.7% and Q4 at 6.3%. For one thing, they also have a high base, especially Q4. But most of the economists said these are subject to change after we look at the Q2 numbers. Overall, if you average it out, the full year number comes now at 7.02, which is very good. Because if you remember the CEA, when he presented the economic survey before the budget, he said he expected 6.3 to 6.8. The most optimistic number was 6.8, but now economists are saying it can be above 7%. Again, nominal GDP is the worry. It is going to grow by 8% according to our poll. You know, nominal GDP is important because that is what gets counted in the budget. That is what gets counted in earnings forecasts of companies. You don't take out the price effect. You just take the profit. Now that, if it is overall is growing only at 8%, you have a problem. There could be an earnings growth problem if nominal GDP is that low.
And with that, we call time on this edition of Trading Hour, the last one for the week. For Sonal, Reema and me, thank you for watching. And Halftime Report takes the action forward on the other side.